I was 23 years old when I decided to jump into real estate investing full time. Looking back now, 20 years later, I realized it was sort of a crazy move, maybe even a little stupid. I didn't have a real job. I didn't have a lot of experience in real estate. All I had was a few $1,000s in the bank and a whole lot of enthusiasm. But I did find a way to start buying properties at 23 years old without much money. And that got me started on a path to buy dozens of properties since then. And today, those properties give me passive monthly income that allows me to be financially independent and do what I want with my time, like living in Spain for a year with my family. I want to take you back in time to those early days and tell you the story of 3 properties that got me started in real estate without much money. My hope is that the details of these stories will give you the inspiration to buy your own real estate investments, even if you don't have a lot of cash. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach, and this is a show to help you build a thriving rental property business so you can get out of the financial grind and do more of what matters. The story actually begins a year earlier when I was still living on campus at Clemson University in South Carolina, where I had recently graduated with a degree in biological sciences, and I'd also recently finished playing football, which, believe it or not, I was a middle linebacker, a lot bigger at that point, and I was at one of those transition points trying to figure out what I wanted to do. And so I just took a few classes at Clemson University to learn a few things, to kill some time. And I was in a business class, which was very interesting, but it was the professor that was really the big change for me. His name was Louis Stone. I call him Dr. Stone. And during the course of listening during class, he talked about real estate investing, how he had rental properties. And one thing led to another, but I started showing up after class, asking questions, talking about what he was doing, and he let me ride around with him and look at some properties. And I became friends with him, and he became a sort of mentor to give me some guidance and really just inspire me to get started in real estate investing. So I stayed in touch with Dr. Stone, but as I told you earlier, I didn't have a lot of money at that time, so I decided to move back home with my parents in Noonan, Georgia. And I did this, of course, to save some money, but I also did this because I had the opportunity. My dad was actually buying rental properties at that time, and I'd heard this idea of something called a bird dog. So a bird dog is a hunting dog that points to birds, then the hunter actually gets the birds. Well, I was a real estate bird dog, and I would go out and look for vacant properties. I would look for foreclosures. I would talk to real estate agents, did everything I could to drum up some opportunities. But then my dad, the rental property investor, actually bought the properties, and I made a small fee every time he bought a property. So for me, it was a great opportunity, obviously, to have a family member in the business, and I was able to make a little bit of money, learn how to find deals, which is a very valuable skill. But by the end of that year, I was ready to do something on my own. So I moved back to Clemson, South Carolina, where I'd gone to school to start buying properties with a new business partner who was a friend of mine from college. And by the way, neither one of us had any money to buy properties, which is not the recommended way to start a partnership. But we divided all the tasks and we both worked really hard, and we're still business partners now 20 years later. So together, my business partner and I started hunting for properties, and we found our first deal through our real estate agent. She was sending us listings every single day off the multiple listing services, and one of those listings was a brick one-story house that was vacant, and a bank had taken it back at a foreclosure, which is the legal process when someone doesn't make their mortgage payments, when the bank takes the property back. So they wanted to sell the property, it needed some work, and we made an offer to buy it. So I'm going to tell you the numbers on this first property and the other 2 properties that we bought just to make it more real so you can understand the details of how it worked. But I want to make the note that this was 20 years ago. So any of the numbers you hear, you could pretty much just double them because of inflation since that time. And I'm buying in South Carolina. So if you're listening in New York or California, of course, prices are even higher there. But if you double those numbers, there are properties like this in the United States today in 2023. So we bought this property for a price of $55,000, and we paid about $1,000 in closing costs. So our purchase costs were about $56,000. We had $18,500 in repairs. That was more than what I estimated. I think I estimated about $12,000 to $15,000 in repairs. Remember, double those numbers for today. We had $3,500 in holding costs and about $6,000 in sales costs when we flipped this property. This was not a rental property for us. We bought it to fix it up and resell it. So those sales costs were commissions and closing costs and things like that. So when I do the math for you and add all of that up, we had about $84,000 in total cost for this property. And when we turned around and sold it, we sold it for $96,000. So we made a profit of $12,000, which for us was a big deal. That would be about $24,000 today. So not a number that's going to make you rich, but for me at 23 years old was a big deal. So as you listen to those numbers, I hope you're asking the important question, Chad, how did you come up with the money? It's one thing to make a profit on a deal, but you had to come up with a lot of money to buy it in the first place. Where did that come from? And the answer to that is back to my professor, Dr. Stone. So in the meantime, he came back into our story as we were looking for properties and evaluating them. I went to him and just had an informal conversation. I wish I could say I had a big sophisticated pitch where I showed him slides and gave him a business plan, but it was pretty informal, probably sitting at a McDonald's or something, writing on a piece of paper saying, Dr. Stone, if we can find a property that's worth around $100,000 and we could buy it at a pretty low price, let's say that my cost of buying it and remodeling and everything is about 70 to 75% of the value of the property after it's fixed up. So in this case, $100,000 property, that'd be like a 70 to 75,000 all-in cost of purchase plus remodel costs. So my question to him was, if I find a deal like that, is there some way that you could come up with the money and we could buy the deal together? The short answer to the question is Dr. Stone said, yes, if you find a deal like that, then I can help you come up with the money. And specifically on this deal, Dr. Stone had a relationship with a local bank who was willing to extend him credit to allow him to buy a property that's an investment with what's called a construction loan. So in this case, the bank was willing to loan him $70,000 on this property that we were buying. Remember, for $56,000, that's worth over $100,000 after repairs. Because we bought it at a low price, we had some equity in the property, and the bank was willing to work with him and loan him $70,000. So we decided to join forces and buy the property together in an LLC. So we formed a company together. And as you can remember, my business partner and I didn't have a lot to bring to the table other than this deal that we found, other than the fact that we were willing to put our time and effort into managing the property, getting it fixed up, getting it sold. Dr. Stone's part of the bargain was his credit, his down payment. There's a little bit of extra money that we had to come up with for holding costs and some extra repairs, about $8,000 before we sold the property. So that was his job, come up with the money, the loan, and we were just kind of along for the ride on the loan, but we brought the deal. So we each had our roles to play on this first deal. Now, overall, this first deal was a win. We made money on our first deal. We learned a lot, even though we made some mistakes, like we hired some bad contractors who, if we would have looked up references, we probably would not have used again. And we underestimated some repairs, but we walked away with some money in the bank. But more importantly, we had a relationship with Dr. Stone. We had proven that we could buy a deal and pay it off and sell it. We'd also built a relationship with this bank. So although we didn't have anything to bring on that first deal, after them seeing us do that first deal, we had more credibility and trust with that bank, which led us to our second deal. So we found our second deal while we were still fixing up our first deal. We actually closed on it about a month after we sold our first deal. It was another single family house. We found it again on the multiple listing service through our real estate agent. It was a foreclosure that a bank had taken back, and we just made an offer that was less than what the listing price was, but we ended up getting the deal. So let me tell you a little bit about the numbers first, and then I'll share how we found the financing for this property and some takeaways we had on our second deal. We bought this house for a price of $65,000. We put about $1,000 in closing costs, and then we had $22,000 in repairs and about $3,500 in holding costs, which if you remember from the other deal are things like interest on our loans, utilities, and other holding costs like taxes and insurance. And then finally, when we sold the property, we had closing costs and sales costs to get rid of it. We had to pay a real estate commission, and we had some closing costs, which in total are about $9,000. So when you total up all of that, our cost of purchase, the holding costs, the repairs, the sales cost, it was $100,500. That was our total all-in cost on this property. And we were able to sell it for $122,500. So again, this is a flip property for us. Later in our career, we started holding more properties as rentals, but we ended up making over a $20,000 profit on our second deal. So I want to mention again, remember, this is 20 years ago, so just double any of these numbers. It might have been equivalent to like $130-something thousand purchase. And when we sold it in our area, there are houses today that you could sell just like this for about $240,000. So that's the 2023 version of these numbers. So I want to talk about how we came up with the cash for deal number 2, because we still didn't have cash laying around. We did flip that first property. We made $12,000, but after you pay taxes, after you split it 3 ways, after you use that money to live on, we didn't have any money to put into the second deal. And so we went back to the local bank. That was the key to our second deal. And the local bank looks for a couple things. Number one, they want to know that you have a performance record, and we are at least doing a little better. We did one deal they could see we had done, and they saw the details of it, and we paid them off quickly. That was important to them, in addition to credit and other things that you normally get with a loan. But banks and lenders want you to put money in the game. They call that skin in the game. We didn't have any skin to put in the game, so this is where we had to get creative. And we did what's called a second mortgage with the permission of the bank, the first mortgage. The bank loaned us $52,000 on this property that we're buying for $65,000. But we learned about a new technique. We're always learning and studying something called a self-directed retirement account. And this is something we talked to Dr. Stone about and said, Dr. Stone, do you have any money in a retirement account that you'd like to invest in real estate instead of being in the stock market or instead of being in a CD in the bank or something? We could pay you, let's say, 10% interest. That was the interest rate we negotiated with him. And so in this case, instead of partnering on the deal and doing a three-way LLC, and it's a little bit more complicated and a little bit moving parts, we didn't do the LLC anymore. My business partner and I bought the property, and we just borrowed money. First from the bank, $52,000, and then we borrowed $37,000 from Dr. Stone. That's what's called a second mortgage. It's not always common in the residential world when you're moving into a property, but there are second mortgages on properties like home equity lines of credit. Other investment type loans sometimes have second mortgages. And so he was in second position with his self-directed retirement account. He was able to make us a loan from his retirement account and earn interest without having to do any of the work on the property, just like before. So we were able to borrow $89,000 total to use to buy the property, to fix it up, and then to resell it. We paid our interest to the bank every month. We paid our interest to Dr. Stone every month. And then a few months later, when we finally got it fixed up and sold, we then paid both of them off when we sold the property. Finishing deal number 2 was a game changer. At 23 years old, having over $20,000 in the bank, I might as well have been a millionaire. I felt flush with cash, had a lot of confidence, but looking back on it, the real game changer were the strategies we learned. Being able to go to Dr. Stone and introduce a new idea of, hey, if you have retirement money and you can move it over to a custodian who can allow you to self-direct it and loan it to us to buy real estate, that one strategy is something we replicated over and over again for the next 20 years. And that became the number one way that we borrowed money, not only to buy flip properties like those, but also to buy our rental properties. We still went back to the banks here and there, but our private lenders were the game changer. That was how we continued to grow. That's how we used the leverage of our success on that first deal and the little bit of money that we started accumulating to do more and more deals down the road. Now, before I move on to deal number 3, you might be wondering about an important detail of deal number 2, which is why would Dr. Stone loan his money in a second position mortgage? If you know a little bit more about real estate, being in a second position mortgage means you're last. If I stopped paying Dr. Stone, the bank would foreclose on the property and wipe out Dr. Stone's money. So why in the world would anybody want to make us a loan in that situation? And the answer is, and this is really important for all of the deals we did after that as well, is that Dr. Stone was concerned about his loan to value. So he wanted to know that the total amount of loans that we were borrowing on that property, the bank plus his loan, were around 70%. So in this case, we were about 72%, which was in the range of what he was okay with. And the reason that's important, people who are loaning private money, hard money, some other loans like that, they want to know that in a worst case scenario, they have some equity, some cushion above and beyond what they're loaning you in case things go wrong. If they had to take the property back and they had to resell it, if they had to take the property back and refinance it, the lower the loan to value, the more options they have. So loan to value is a key concept to remember if you also want to start using private money lenders. We bought deal number 3 later in that same year, and it was actually on the same street as deal number 2. So it's a good lesson we learned that if you already own a property in a neighborhood, be sure to look around the neighborhood for other properties that need work, that might be vacant. And we actually bought this property directly from an owner. So I want to tell you a little bit about the numbers of the property and then again, how we came up with the money to buy it. So we bought this house for $60,000 and put $1,500 in closing costs when we bought it. We decided to use a little bit different strategy on this one. It didn't need quite as much work, and we thought we could resell it just by cleaning it up, essentially. So we spent about $3,000 in cleanup and some minor repairs. We had about $3,000 in holding costs, and then when we went to sell the property, we didn't use a real estate agent. We just put it out on the market to other investors who were looking for deals and other handy people who just wanted to move into a property. And we found a buyer for $76,000. And our total cost, if you added up all the purchase costs and holding costs and closing costs and repairs, were $68,500. So we made a small profit of $7,500, but we made a profit. And in today's dollars, again, 2023, double that. Maybe that's like a $15,000 profit. So instead of fixing it up and trying to make more, $20,000, $30,000, we just said, hey, let's just make less, move on quickly, and sell the property. So how we got the money for deal number 3 is a good story about using stories. So at the same time we were doing deal number 1 and deal number 2, we of course are excited about what we're up to. And so we're telling people about it. We're telling our friends, we're telling friends of friends. And we happened to be talking to someone who was a friend of a friend, who's also an entrepreneur and did a few things here and there. And we were just saying, hey, we've got this property. We're buying it, we're fixing it up, and he's asking questions. He was curious about it. And so we're happy to oblige. Just like I'm doing on this video, I would draw on a little piece of paper or a whiteboard and show the numbers. And something stood out when I talked to him about it though. He said, how are you financing this? You're 23 years old. What's going on? He was just curious. And I said, well, actually, I'm borrowing the money from a bank, but also another individual, and we're paying him 10% interest. He's loaning us the money. And that was the key thing that kind of perked his ears up. He said, you're paying him 10% interest on his money. And he had some money sitting there in the bank. He also had a line of credit on his house. And he was interested in just having some of that money that was sitting there earn some more money. So on this third deal, we just, after that conversation, said, hey, well, if we get another deal, you want us to let you know about it? We can at least just take a look at it. Maybe we could do something together. He said, sure, stay in touch with me. Let's talk about it. So when we got to deal number 3, we reached out to this person and we said, here's the deal. We're buying it for $61,500. We think we're going to sell it pretty quickly, but we need the money to buy it, maybe pay for the closing costs. Could you loan us $62,500? And so he agreed to loan us $62,500. He had enough cash plus a little bit extra from his line of credit to loan us $62,500. He was basically our bank. So he used his own money and he had a mortgage on the property. He had a promissory note. We promised to pay him back, but if we didn't pay him back, he'd have to take this property back. And we agreed to pay him 10% interest while we were waiting to sell this property. So in the end, we had a few $1,000s out of pocket because we had some repairs and some holding costs and things like that. We had a little bit of cash in the bank from deal number 2. We turned around and sold it, remember, made a profit, and we paid this person back. So we used another private lender to put up most of the money, not 100% of the money in this case, but most of the money to do deal number 3. So those 3 properties I just told you about, that's how I got my start in real estate investing with very little money in the bank. Now, fast forward about 20 years to where I am today, we have 100 plus rental units. My business partner and I do. It's about 30 buildings because some of those are multi-unit properties, and we are buy and hold investors. And when you get to this point where your properties go up in value, the rents go up, you pay off some of the debt on the properties, you can get to where you can live off the rental income. And that's what my family and I do today. I'm living in Spain right now, spend about 2 hours per week on average on my rental property business because I have systems, because I have some team property managers back in the town where the properties are, managing those properties on a day-to-day basis. And so I share all that with you to give you some hope, to give you some inspiration. If you're just starting or if you're early in your journey or if you've run out of cash and you want to buy more properties, you do have to get creative. You do have to think outside the box, but there are ways. That's one of the beautiful things about real estate investing is there are techniques to get into the game, even if you don't have a big pile of cash. So I hope this has inspired you to do that. I want to leave you with a few lessons that I took away from those deals that I hope will also be lessons that'll help you if you're out also getting started or buying your next properties and you're trying to do it with a little bit less cash than you like. The first big takeaway is that if you want to buy properties with little or no money and do it safely, you've got to buy really good deals. And what that essentially means is you need to buy them at a pretty low price. So remember that term loan to value or cost to value. You want your cost in the deal, your purchase plus your other costs for repairing and fixing the property up. You want those to be below 70, maybe 80% of the value of the property. Now, can you do that on every single deal? Is that always possible? No, not always. And it doesn't mean that if you pay 100% for a property, that's necessarily a bad deal. It just means that you're gonna have to put more cash into that deal. You need to evaluate it that way. I was someone who was scrappy early in my career. I didn't have a lot of money. So if you don't have a lot of money, you've got to bring something to the table, which is finding those diamonds in the rough, those properties you can buy below value. You've got to hunt for them. You got to look for them. You got to bring that to the table. And if you find that kind of deal, there's always going to be people who have the money if you buy it at a good enough price. The second takeaway from me was that if you're new to anything and to real estate investing in particular, the number one priority for you is to build a track record. You've got to build credibility. That trust with the bank that I had, showing them that I could perform, showing them that I could pay off their money, the trust that I had with Dr. Stone, and then that trust that I could kind of borrow and use with a third lender, that all started because I got a track record. And if I had waited for the perfect opportunity, if I'd waited to pay the perfect interest rate, we paid 10% interest on our first few loans. That's not great. I'd like to pay less than that, but you have to establish a track record. You got to do something. And I look at it as you've got this piece of a pie of a real estate deal to profit. Don't get greedy and try to grab and get the most you can of every deal, especially when you're early in your career. Share that pie with other people, share it with your lender, share it with a partner, but getting that track record, getting some momentum is everything for the second, the third, the fourth, and the fifth deals down the line. The third thing I learned in those first few deals was that relationships and trust matter. They matter a lot, not only just to be a human being, be a decent person, but from a financial standpoint as well. I did deals for the next 20 years with Dr. Stone. I did deals with that same bank 20 years later based on the trust and the relationship that I built in that first year. So paying on time, showing up on time, communicating well, all those little things that establish trust early in a relationship with anybody, those are seeds that you're planting that grow into a long-term relationship of trust where you can make money together. And so it is really important for us as private lenders. I told you that we bought a lot of our properties with private lenders. We only had to use a small group of people, including Dr. Stone. He told a couple friends about us and how we were doing business. Another person started working with us and they told their friends. With 5 or 6 people who each loan $200,000 to $500,000 each, if you're buying $3 or $4 million worth of real estate, that's all you need. That's all we had to use. Private lenders in a small circle. It keeps your business very simple when you have trust, when you have relationships with people. And it's not just a fuzzy thing. It's not just a nice to have thing. This is a quantifiable business asset for yourself as a real estate investor. And so work on it. Work on establishing trust with your banks, with your private lenders, earning that trust, being trustworthy. It can be the key that unlocks all the rest of your real estate investing business. So if you like this format and this video of going behind the scenes with real deals, I want to invite you to the next video where I analyze a duplex property, a real property, and show you how I would look at the numbers, how I would look at the neighborhood, and go in depth to give you more confidence so that you can run the numbers and analyze your own deal. So it'll be in the video description below. Also somewhere above me here, you can just click that and check it out. And if you have any questions or comments on this situation, this video that I covered, be sure to leave those below. I would love to hear from you. And I'd always appreciate a like, hit that thumbs up. It helps me to spread the word to others on YouTube.